Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Weekly for Saturday, August 15th, 2020. And our top story this week, we'll take a look at the UK pension and retirement system. Joining me now to discuss this and more is Darren Philp of Smart Pensions, based in the UK, of course. Darren, thanks so much for joining us on the program this morning.
I'm good, thanks very much, Jeffrey. How are you?
I'm doing quite well. Thanks so much for joining us this morning. I thought before we kind of get into the state of pensions in the UK, let's just start off with how is savings and how are people doing financially with regard to the coronavirus pandemic?
It's a really good question, and it's obviously a really topical one as well. And actually, we ran some member webinars just recently, a few weeks ago, and we actually asked them that question because obviously it's incredibly topical. And the results were quite surprising because quite a large percentage of people were in exactly the same position as they were previously. And I think that is a result of the government's furlough scheme. So in the UK, people have been paid to stay at home and not work. So we haven't really had the full effects of the coronavirus crisis come through in terms of working patterns and saving patterns. If I remember correctly, around 20% of respondents to this online survey were worse off. They might have lost their jobs, they'd stopped saving and all of that type of stuff. But around 20% were actually better off because they were continuing to work, like me, working from home at the moment, but don't have travel costs, not going into the coffee shop every day and buying a Starbucks or a Cafe Nero or whatever, and not having to pay for expensive lunches out in London. So I think it's been a really mixed picture so far. I think, though, that the government's already announced that the coronavirus job retention scheme, so the support that people are giving, is gradually going to be phased out over the next couple of months or so. I think it ends in October. And I think then we'll really start seeing the real impacts of the coronavirus crisis on people in the UK where it comes to working and saving.
Yeah, and I think the experience seems to be one that we're experiencing here in the US in terms of people saving more during that period, although it did kind of decline in June a little bit as a result of probably job losses, et cetera.
Yeah.
So let's jump in, and I want to really connect with you about the UK pension system because you and Smart Pension are doing a lot of interesting work there. But let's start off with maybe some of the evolution, things that are happening at the macro level with state pensions there.
Yeah, so state pension, we've had a bit of a checkered history where it comes to state pensions over the years. And I think over time we had one of the least generous state pensions in the world and probably one of the most complicated. So we've been through a series of reforms that I know we haven't got all day, so I won't bore you with now. But what we've done is we've transitioned over time to have a single state pension. That is set at a number which is about £135 a week currently. You need to sort of work your years to contribute to that. Prior to that, there was all sorts of earnings related elements and complicated means testing and all of that type of stuff. So over the last few years, we've been on a bit of a journey to simplify that state pension, to make it much clearer and much simpler for people to understand what they might be getting in retirement.
And how have people received that? I mean, clarity is always a good thing. Transparency is a good thing. Are people more positive? Is there more confidence in terms of retirement, or is it a mix of both?
I think it's mixed, and because it's so politically complicated. So if you're simplifying and turning something that was earnings related into something that's flat related, you'll get winners and losers. Yeah, and if you win, you don't shout about it that loudly. If you lose, you do shout about it quite loudly. So it's quite redistributive in terms of what the government's done on the state pension side of things. The other thing that's happened as well is we've had equalisation of men's and women's state pension age at a time when the pension age has also gone up by a year as well. So there's quite a lot of people that are having to wait longer than they expected for their state pension. And there's a particular group of people called the WASPy women who had their state pension, they had to wait an extra 2 years for their state pension. And that has been a course of massive controversy within the UK.
Yeah, I can certainly understand why. If you have to wait longer, it means you got to work longer or do something else.
Exactly.
And it's a similar story here in the U.S. As I know that you do a lot of public speaking around the U.S. as well as, well, virtually at this point. But it's kind of the same story. In terms of defined contribution, so we have a defined contribution centric system here, although we do have a lot of public plans and we have a lot of corporate pension plans. What is the defined contribution scheme like in the UK?
We very much had a starting position similar to the United States. So defined benefit provision ruled the roost for a number of years, and it was the sort of key way of providing pensions, and for a number of reasons, the popularity of defined benefit pensions has been on the wane for a number of years. Increased regulation, increased longevity. Employers have basically promised stuff to their staff that they just can't afford to deliver over the long term. So we've seen defined benefit pensions just fall off a cliff in terms of them being open to new members or future accrual. And for a while, that wasn't really replaced with private sector defined contribution provision. And that led in the early part of this decade, not this decade, or just at the turn of the millennium, actually, 2003 to 2005, the Pensions Commission did a lot of work looking at this issue. What it found, not unsurprisingly, is that private pension provision had fallen off a cliff, especially as far as defined benefit was concerned, but it hadn't been replaced by good quality DC workplace provision. And while it was suggested that there was no immediate pensions crisis, they set out a lot of the issues around the fact that the system was not fit for purpose longer term. And what that caused the government to do was to introduce a system called auto-enrolment within the UK. And basically what that means, and there's loads and loads of rules and regulations covering this, but it means that if you're employed and you meet certain criteria to do with salary and age and things like that, it means that your employer has to put you in a pension and make a mandatory minimum contribution into that pension unless the individual has opted out. And this is aimed at replacing that defined benefit provision, but also increasing participation across the workforce. So there were certain sectors that have always been well pensioned in the UK, but there are other sectors like hospitality, retail, catering, those sectors where people move around a lot. And auto-enrolment has had a huge impact with them because it means that if they don't make any decisions, they are saving for their futures. And it's estimated that something like 10 million people have been auto-enrolled into a pension as a result of these reforms. So where are these people going? Well, the government set up a backstop scheme called the National Employment Savings Trust. So this was a government intervention to create a pension scheme that had a duty to accept any type of business. And that's been great. It's been innovative. A lot of people were saying it would never work. It was a big government project. It was doomed to failure. All of that type of stuff. But it was there to support the fact that there were a number of sectors that were just uneconomic to serve. But what was really interesting is that because employers have to provide these pensions, a whole new breed of pension provision exploded into being within the UK, what we call master trusts, and Smart Pensions is a master trust. And what those schemes are is they're schemes with a fiduciary duty to do the best things for their members, but also they operate within that trust-based governance framework. Mm-hmm. And they've been really successful at delivering simple, low-cost, transparent solutions to employers and members. And at Smart Pension, one of the things that we've done is we've used technology to make it as easy as possible for employers to be able to meet their compliance duties for auto-enrolment. So even though there was a state intervention of Nest, which people were thinking, oh, it's just going to kill competition and all of that type of stuff, it's actually done totally the opposite. Because it's almost given the pension providers, traditional ones like the big insurers, but also new entrants like Smart Pension, and there are others, an impetus to do better for their members. So we've got the most vigorous competition that we've ever had within our pensions industry.
And it seems like technology has really helped level the playing field when it comes to that competition and also deliver better and more unique solutions for individuals. Is that correct?
I think that's right, yeah. So when Smart Pension is a very new company, yeah, we've only been in existence for 5 years. There was no way that we could compete on our brand or on our proposition, or, you know, we just weren't that well known in the market. So what we could do, though, is we could make things really automated, really cost effective. And that's what employers want. You know, if an employer wants to play pensions, if an employer wants to provide good quality pensions, they've probably got a good few people in their HR, human resources teams doing this stuff. For smaller employers, they just don't have the resource or the knowledge or the understanding to be able to do that. They want to be able to press a button and for it all to happen. And I think, you know, that's one of the things that we have seen over the past, few years, certainly within the UK, a sort of a modernisation of the way we're doing things with a real focus on usability and integration. And one of the projects that we're working on at the moment in the UK as a whole is something called a pensions dashboard. So we've got people who have moved around a lot and people have pension pots all over the place. And people forget that they've got money sitting over there or over there or over there. And one of the projects that we're working on is how can we have a system that can search out people's pensions and combine them all into a really accessible user interface so people can see what they've got and where they've got their money.
Yeah.
And I think that will be really important in terms of bringing pensions closer to the savers, to the individuals. There's huge challenges with that project, not least data quality. You know, how do you know that this down field is the same as this down field? You know, matching, ID verification, and also different parts of the industry want to go at very different speeds on this.
Right.
So you can imagine some of the legacy schemes, the legacy providers are thinking, oh, don't want to do this, and are dragging their feet.
Yeah.
But pensions, people find pensions boring. I don't think we do, Jeffrey.
No, we don't, but I think people do, and we're trying to change that.
We are trying to change that, yeah. But why are they boring? It's because they're confusing. It's because it's difficult to get that information. And we're hoping within the UK that this pensions dashboard idea really takes off, and at least gives people a fighting chance to understand a bit about what their pensions are about.
Yeah, absolutely. Well, Darren, it sounds like there's a lot of innovation and a lot of lessons to be learned by others around the world. I want to thank you so much for joining us on the program this morning and really appreciate it. And we look forward to having you back very soon.
We'd love to. And thank you very much for having me on.
And when we come back, we'll take a look at some of our best stories for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you were like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. On Wednesday, I sat down with California State Treasurer Fiona Ma to see how Californians were doing during the pandemic. Let's take a look.
Well, we were really surprised in the first month that renters were still paying their rent. But as it got further, the second month, the third month, I think people were trying to do what they can to meet all of their financial obligations. And then when we went through our second phase of shutdowns, I think people now are saying, well, I don't know what to do. I can't open. I'm just not going to pay my rent. I'm not going to pay my garbage bill. Come get me, basically, right, is kind of the attitude now. So unfortunately, the longer we are shut down, the harder it is for many businesses. We have many small businesses that have closed permanently. They are never going to go open up. I mean, the rents are way too high. Mm-hmm. And even if we're deferring mortgage payments or other type of loans, that money is still going to come due at some point. And even if you're able to open up your small business, yet have to pay 3 months of rent up front, well, that's not really going to happen. So we have really been encouraging banks and landlords to, defer their payments, work out a long-term payment plan. Otherwise, these businesses, the tenants are just never going to be able to come back and open. And that's what we said early on is go see your bank. As people were panicking, we said, please go talk to your banker, work out some sort of arrangement. And we work with all the banks here in California. So we also have been spreading that same message is that you need to work with your customers. Otherwise, they're not going to come back and you're not going to be able to make your payments either. So we are all in this together. Actually, I chair 15 different boards and commissions, and one oversees education, financing. And so I have a little bit of intel. We just had a meeting last week, and some of the charter schools, those that have both dual virtual learning as well as on-site learning, one school received 1,500 new applicants because, wow, because the school districts, they're kind of on their own trying to figure it out. And those school districts that don't open, it's very difficult for their parents, number one, if they're working. Number two, their children falling behind if they are not able to, to have the proper, curriculum and supervision and teaching that they have at home. So certain institutions that have that type of virtual learning are seeing an increase in enrollment. Certain universities, I also chair a higher education fund. Some of them are going back. Some of them are still closed and to be determined. So it just varies across the board. I mean, when I was born, my parents opened up an account for us and they bought stocks, dividend reinvestment stocks. And by the time all three of us went to college, we had enough money for college. And even after we could open up a business or put a down payment on a home. So my parents from early on taught us the importance of savings. Yes, financial literacy is super important. We launched a financial literacy program earlier this year with students between the age of 14 to about 22. And we had 24 students, 4 sessions every Saturday, 9 to 12. And they were impressingly, they were like engaged. They were listening, they were participating, they were going home and doing their homework in terms of setting a plan, and then also just, hungry. Their parents also came, and after the last session, some of the parents said that they got a lot out of it because nobody taught them about financial literacy. So we are going to be launching a financial literacy program that's in our next 6-month to-do list. Since we've got time and everybody's on Zoom meetings, we think we'll be able to launch a pretty good curriculum that can get everybody who wants to listen, from junior high to high school to also parents who are also starting their families. We think it's important that everybody have the understanding or have the basic knowledge, and not a lot of people are doing financial literacy. I am very active with the National Association of State Treasurers, and yes, we think it should be mandatory. It should be part of the school curriculum, just like all the other important topics. But if you don't understand, when you go to college, when someone offers you a credit card and they say, "Hey, you can get free money," it is not free. No. And if you don't pay back your credit card, then that starts you on a downward spiral of affecting your credit rating, not being able to take out credit cards later on, not being able to get a loan. High student loan debt is another area that we are focused on, and we're issuing an op-ed right now and pitching it in terms of all the different ideas that are out there for abating or assisting or refinancing high student loan debt. But that also follows you throughout your life unless you can pay it off. And when you have very high student loan debt, you may never, ever pay it off. And therefore, you're always going to be stuck, like being a renter or using cash and not being able to accumulate credit like most normal people do, to buy a house and to also build equity.
And on Monday, I was joined by MarketWatch's Jacob Passy to discuss whether you should buy or refinance your mortgage. Let's take a look.
Start of the pandemic, I did an interview with the CEO of Quicken Loans in which he said that he did not expect rates to drop below 3% anytime soon. Sure enough, a few months later, that's exactly what they did.
Yeah.
And it's kind of crazy. If you look at the long history of mortgage rates, who would have thought we would have gotten to this point? We didn't get this low even during the 2008 financial crisis. This is an all-time low, and there's room to go lower. So as you and I discuss a lot on the podcast, mortgage rates are short-term rates. So they follow the direction, or are not short-term rates, they're long-term rates. So they follow the direction of long-term bond yields. So movements in the Federal Reserve, things like that, those don't directly affect mortgage rates. What really will move the needle with them is the movement in the 10-year Treasury note, for instance, the yield on that. So that has dropped to an all-time low because of the pandemic. And so there's the gap between the 10-year Treasury yield and the 30-year mortgage rate has widened throughout the pandemic. So that suggests there's room for rates to go even lower on mortgages. So I think if you're someone who's looking to buy a home, or if you're already a homeowner and you haven't refinanced, this year or in recent years, it's certainly something to be looking at. The refi volume is definitely elevated. Like you just said, in March, we saw a massive wave of refinances when rates were really starting to drop. Yeah. They've obviously dropped even lower since then. Anecdotally, I've spoken with homeowners who, because of that massive wave back in March, it took so long for a lot of lenders to work through the pipeline. So, a friend of mine who was looking to refinance her home, she actually just a couple weeks ago switched the lender she was going to use because she had not yet closed with the original lender she was dealing with. And then another one came along. She was working with a mortgage broker who can, compare different rates. And her broker came back with an even lower rate than she got back in March. So she snagged it and is hoping to, close pretty soon with them. Like you said, though, don't try to time the market. I mean, these are rock bottom rates, and the chances of rates dropping significantly enough from here such that, you know, it would make sense to wait are not guaranteed. You know, there's no guarantee that rates will drop to, you know, 2% or something crazy like that. And to be sure, you know, if you've already refinanced in March, you shouldn't necessarily refinance now. You know, if there are costs involved, closing costs, things like that. And, you know, you want to make sure that you're getting into a loan where you'll break even such that, you know, if you're planning to move in a few years, it may not make sense to refinance because the closing costs that you pay to refinance might be, you know, more expensive than what you end up saving through the lower interest rate. So lots to take into account. I think, you know, if you're looking in the market right now, you know, some things to keep in mind if you're thinking about refinancing. First off is the term. You know, if you're in a 30-year mortgage right now, rates have dropped so much in recent weeks that, you know, it might make sense to get a 15-year mortgage. You may not end up paying less each month. You might have the same monthly payment, but you'll pay off the loan so much quicker, so you'll save so much more in interest in the long run. Other things to consider are, you know, talking to your current, you know, mortgage servicer or lender to see if they have any options available to you for refinancing. They don't want to lose your business, so they may be able to cut deals in terms of closing costs and things like that. So those are some things to, you know, keep in mind if you're pursuing a refinance. So the real estate market is definitely hot right now, which is very surprising, like for all the reasons that you just mentioned. Home buyers, there's tons of pent up demand. Folks, especially millennials, really want to become homeowners. They're looking at these rock bottom mortgage rates right now and are like, hey, this is the best time to lock that in. Yeah. So that is driving a ton of demand at the same time when supply is still very much constrained. You know, even before the pandemic, at the start of this year, real estate economists were saying that, you know, the home sales activity that would occur this year would be constrained because there just weren't enough homes available for sale for, you know, there to be, you know, a huge growth in home sales. And that's still the case. And it's even more the case because the pandemic scared some sellers from putting their homes on the market. They were looking at this tumultuous economy with, you know, record unemployment, and we're thinking this is not the time for me to put my home up for sale. And so a lot of those folks haven't come back into the market. And so buyers who are looking to buy right now are facing even they would for a very small number of homes. Right. That being said, there are some interesting trends that are occurring across the country. And so depending on where you live, you might have an easier time. So one big trend that lots of folks are talking about right now is the flight to the suburbs. You know, folks living in densely populated major cities who are looking at, you know, many, many more months of working remotely from their cramped apartment with no backyard are suddenly taking a liking to the suburbs. And even before this pandemic, in cities like San Francisco, we were already seeing folks moving out because of the record high home prices in those areas, and rental prices too. This isn't just home buyers, it's also renters looking to move. So there's suburbs happening and it's picking up steam. What that means in the long run, interestingly, is in, you know, major cities like New York, you might end up finding deals. And some real estate economists actually believe that home prices in urban parts of the country, you know, the downtown areas of major cities, because of this trend. So in Manhattan, in, you know, San Jose, San Francisco, you might see home prices actually come down because people are looking to more affordable areas and areas where they can get more space.
Well, certainly an amazing week of shows. I want to thank all of our great contributors. And that wraps up this episode of BRN Weekly. But as you know, we're not done for the week because tomorrow I'll be joined by members of the media, academia, and financial services to analyze all the news in retirement markets, technology, personal finance, and so much more on the BRN Sunday podcast. You're not going to want to miss that show as well. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.